Hello all, welcome to this session regarding tax planning. So, tax planning chapter, sir, many things like it is a theory chapter, but not at all it is a theory chapter. It requires your analytical skills, okay, like various provisions you can correlate. Majorly, like the basics you should be having like on your fingertips. Chapter 6A deduction should be on your fingertips. Then PGBP provisions you should understand. Capital gains provisions very rarely, but the basic house property things like how much will be the standard deduction, interest, that part you should know. Salary is also one or two sums are there, sir, but my gut feeling is like even though salary questions are there in model question papers for some attempts, but they didn't ask in exam. So my gut feeling is like they don't test it on salary, but I'll explain in this video one or two questions we are having that also. So this chapter is purely about solving questions only. Now many will ask, sir, is there any selective question? Sir, each question will be a different way. Okay, there's no repetition of pattern here. So they'll test, like planning can be done in any way. So one person will have 2-3 incomes, another person will have another kind of incomes. So you need to do. So he'll give you two alternatives. You need to check it in two alternatives and you need to tell which is the best option. And then some FM basic questions they'll be asking like whether to buy a machine or to lease a machine, or whether to take a loan or to fund it from equity or from debentures. So which option is better? Such kind of questions are there. Theory is hardly for one page only. What is tax planning? What is tax management? What is tax avoidance? And that related questions are also only 3 or 4. If such question comes now, it is easy. I'm gonna tell it also, but towards the end of this session. Okay. First we'll be focusing on questions only, sir. So straight away I'm gonna take the last question, and this PDF is already shared in the tax group. BCCA group. Okay, so there you can find it, this PDF and all. Okay, then go through these questions, sir. Okay, even so many people messaged yesterday also, tax planning we don't have much questions, where to find out, and this will be suitable for you. Okay, see straight away, sir, we are attacking the questions. So I'm saying, sir, this question June 2025 questions, there are like 2 questions are there. First we are solving those questions only. We'll see, without learning PGBP chapter, these 2 you cannot attempt. But if at all you hate PGBP, then question number 2 is also at stake, 3 is also at stake. Then you should study properly business restructuring and NR taxation, and you shouldn't take any chances now. So go with the capital gains also. Those videos are also already uploaded as the part of this revision series. You can go through them. Okay. So before we'll start the question, I hope you are really enjoying these videos and you are having clarity. These are being useful to you. So please like, share, subscribe, and even put a comment. Okay, from where you are watching also. Sara Private Limited Kanpur is a newly manufacturing company incorporated on 16th Jan 2021, who commenced manufacturing activities on 1st April 2021. Its net profit as per statement of P&L was 30,90,000 for the financial year 24-25 after debiting and crediting the following items. Okay, so they are given, sir, it's a pure PGBP sum, sir. They given P&L profit and they said like certain debits and credits, additional information. At last they given the turnover 200 crores. Why turnover they given, sir? They never exceeded 200 crores turnover. So it's a hint to tell that okay, the turnover is within 400 crores, so the tax rate is like only 25%. But if you look at beneath that one, you are required to suggest the company whether it should opt for the provisions of 115 BAB or not by clearly showing the relevant computations. So look at here, when 115 BAB is applicable, it should be a domestic or manufacturing company set up on or after 1st October 2019 and before 31st March 2024. Okay, if they opt for 115 BAB, what is the tax rate, sir? See, on PGBP income, the tax rate is 15%. On short-term capital gain on sale of depreciable assets, the tax rate is 15%. On all other special incomes like 112, 112A, 111A, on them special rates only applicable. Whereas on the other incomes, okay, other IFOS and other incomes, any other income, they will be having house property income, IFOS income, all are taxable at 22. Plus additionally there will be surcharge on all these at a rate of 10%. This is 115 BAB. So they are asking us to do what? Do it under both 115 BAB as well as under the normal resi. See, sir, already they debited what? Depreciation as per Companies Act. The depreciation which is debited as per Companies Act, what we should do? We should add back, and we should allow the depreciation as per Companies Act, as per Income Tax Act section 32. So we have added back this depreciation and we subtracted the normal depreciation. But this fellow is having additional depreciation also. Usually additional depreciation also we should subtract. But if a person chooses for 115 BAV, then he cannot claim additional depreciation. Sir, one more point, sir. For individuals, the new regime is the default one. For individuals, the new regime is the default one. Old regime is the optional one. But for companies and all, the old regime is only the default one. New regimes like this 115 BAB are like optional. Okay. You are required to suggest whether it should opt for the 115 BAB or not. Okay. Depreciation we understood. Okay. For normal regime, in case of normal regime, what they should do? Depreciation add back, and this 4,90,000 and 1,50,000 normal and additional depreciation, it has to be subtracted. If they choose 115 BAB, add back only 4,50,000 and subtract 4,90,000 only. Okay, you should not consider additional depreciation in that case. Then employer's contribution as well as employees' contribution to EPF of 11 lakh each for deposited on 31st May for month of March. Sir, employer contribution, if it is deposited by due date of filing return of income as per 43B, it is allowed as deduction. Whereas employees' contribution is allowed as deduction only if it is deposited by the due dates of PF Act. So the due dates will be in the next month only. For March month, usually due date will be within April only. But here they deposited in May. So employees' contribution not deposited within the due dates of PF Act. So it is what? Ineligible. So employees' contribution, what we should do? Add back. Employees alone we should add back. Then dividend 17 lakhs from another Indian company. Sir, dividend is also credited to P&L, but dividend is taxable under which head? IFOS head. So you should subtract dividend here, and the relevant expense already debited to P&L, what you should do? Add back. Okay, so first if you do, you will get what? PGBP income. Okay, so this answer which is given in the material is wrong, so I already computed it again. See, so we have taken 30,90,000, 30,90,000 under both the regimes, added back depreciation as per Companies Act, employees contribution 11 lakhs disallowed, added back, expense for earning dividend not related to PGB paid income, added back, then depreciation normal subtracted, additional depreciation subtracted only under the old regime, whereas under new regime additional depreciation didn't subtracted. Then dividend income 17 lakhs because it is taxable under a different head, that is also subtracted. Then we got the PGB head income as how much? 26 lakh 60 and 28 lakh 10,000. Okay, so the major mistake where the students can do in this question, sir, they'll miss about additional depreciation, 1 point. Okay, provided even PGBPL you know also, additional depreciation is not available to 115 BAV opted persons. It's okay, that you may miss. So that point you should remember here. Then IFOS. Sir, under IFOS head, sorry sir, there's a mistake here. Okay, okay, so what is that? Sir, dividend, how much is there? 17 lakhs they earned. Dividend, how much they earned, sir? 70 lakhs. Sir, when they earned dividend, okay, this line only, sir, so the total will be correct. Dividend 17 lakhs. How much expense they incurred? 3.6 lakhs. Okay, 3.6 lakhs. But can we subtract whole 3.6 lakhs? No. In IFOS, sir, for earning dividend, if any interest expenditure is expended, such interest is allowed as deduction, but only to the extent of how much? 20% of the dividend. So 3.6 lakhs or 20% of 17 lakhs, which equals to how much? 3.4 lakhs. So that expenditure allowed is only how much? 3.4 lakhs. So 17, from there if you subtract 3.4, what is the IFOS income, sir? 13 lakh 60,000, and here also 13 lakh 60,000. Okay. The gross total income, correct only, sir. If you added this, gross total income is 40 lakh 20,000, and here it is like 41 lakh 70,000. Okay, so this dividend point is the crucial point where many will miss that 20% expense. So additional depreciation, then this dividend point, then you got gross total income, done. Then the next thing is like ATM. There's a new deduction introduced, sir, by Finance Act 2 2024, ATM. So what is ATM? ATM is a deduction available only to companies regarding intercorporate dividend. Okay, so when they are receiving dividend and they are even paying dividend, then dividend received or dividend, net dividend received or dividend paid, whichever is lower can be claimed as deduction under ATM. Sir, here the dividend received, again people will be taking it as like 17. No, you should consider only the net dividend. Okay, net dividend, how much they received, sir? 13 lakh 60, 13 lakh 60. Okay, 13 lakh 60,000 and 13 lakh 60. That can be claimed as dividend. Okay, that could be claimed as deduction, or the dividend paid. How much dividend they paid, sir? In the question, if you see, they said like the dividend declared and distributed is like how much, sir? 20 lakhs. So they can claim this 13 lakh 60,000 or 20 lakhs, whichever is lower as deduction. So this is the third important point where you could do mistake. So subtract 13 lakh 60, 13 lakh 60, then you will get what? 26 lakh 60 and 28 lakh 10,000. Then tax rate. Sir, under default regime, again you will go for a tax rate as what? 30%. But they already given a hint stating like what? His turnover is only 200 crores, so the tax rate applicable is only 25%. So this is the fifth place where you should be careful about the tax rates. Okay, for the normal person, for under the old regime, the tax rate is how much? 25%. Whereas under the new regime, the tax rate is like 15%. There are no incomes which are taxable under other head. Why? IFO's income is there, but the total IFO's income is claimed as deduction. So the only income remaining is what? PGBP income only. So under normal regime, anyhow 25% only. Even under 115 BAB, there are different tax rates also. The income, everything is like PGBP only. So apply 15% plus surcharge. Okay, here total income is within 1 crore only, sir. Usually when the total income within 1 crore for companies, no surcharge. But if they opted for 115 BAB, irrespective of their total income, they will have surcharge at a rate of 10%. Okay, so this point is also important. So 40 to 150. Then says, if you add and round it off, this is the tax payables. And then which option is better, sir? 115 BAB is the better. Okay, so see, these are the 5 points where you can do mistakes. Even you know PGBP, these 5 points you should be careful. Okay, this is a beautiful question, sir. Okay, and many might not attempted this properly. Then we'll move on to question number 21, sir. Question number 21. Bablu is an Indian resident, aged 34 years, started his retail trade business from 1st April 2024. He gives the following information relating to you financial year 24-25. Okay. So Bablu also will solve, sir. What is the net profit as per? Okay, here they are asking what? Last line. Compute total income of Bablu. Bablu is an individual. Okay, under default regime as well as under normal regime. So default regime na new regime, normal regime na old regime. Normal regime na old regime. Okay. So what they given, sir? They given as his net profit as per P&L account. Okay, we'll take net profit. How much is the net profit? Net profit is 51,71,000 under both the regimes. 51,70,000 under both the regimes. Fine, we have taken it. Then what we should do? Net profit includes gross rent received from let out property, and then interest debited to P&L includes interest on loan taken for the purchase of let out house property. Sir, first. Sir, rent received is taxable under which head, sir? IFOS head. But it is already credited to P&L. Income, if it is credited to P&L, if you need to reverse it, you need to subtract. Okay, income side, if anything is there in P&L and that is not relevant to PGBP, you should what? Subtract it. So, rent part. How much is the rent, sir? 1,20,000. You should subtract here. 1,20,000 you will be subtracting under both the regimes. Then you will add back. How much you will be adding back, sir? You will be adding back 2,20,000. Okay, why? That, sir, if income is not taxable under PGBP, then that relevant expense also shouldn't be debited to P&L na. So reverse it. So how much? 2,20,000 and 2,20,000. Then any additional information is there? Yes, additional information. These are not passed through P&L. He has a deposit in PPF 2 lakhs. Medical insurance premium for self and spouse 30. Okay, that will take after PGBP, sir. So now if you look after PGBP income, how much? 52,70,000. Here also 52,70,000. Okay, PGBP income we got. Then we'll go to what? House property. Income from house property. Okay, it's a let out property na. how much is the rent they received, sir?
1,20,000.
Rent is like 1,20,000. Okay, for both of them 1,20,000 is the rent. From there we should avail what? Standard deduction at 30%. How much? 36,000. So subtract 36,000 for both of them, both the reasons. Then 84,000 is what? After deduction. Then interest allowed, let out property. How much is the interest allowed, sir? Sir, under old regime the total 2,20,000 can be claimed as deduction. So then what is the loss from house property? 84,000 minus 2,20,000. If you do, you will get loss.
1,36,000 loss.
Okay, sir, even under new regime also you can claim. Okay, new regime or even under old regime you can claim interest on let out house property. Okay, how much, sir, the loss?
1,36,000.
1,36,000. But the point to be remembered is like under new regime such loss from house property can be adjusted only within the head, whereas under old regime that can be even adjusted with other heads also. So in new regime, sir, we cannot take any house property income because it is lost. It has to be carried forward only. It can't be adjusted with any other head income. But whereas under old regime, this 1,36,000 we can set off with PGBP income. So I am taking it in this column. So how much will be the gross total income, sir? There are no other incomes, right? Yes.
For default, like 7.
Gross total income under default is like 52,70,000 only, whereas under old regime it would be 51,34,000. 51,34,000. Then we'll go for chapter 68 deductions. Sir, understand, if a SSE has opted for new regime individual, then he will get only deductions like 80 CCD subsection 2, 80 CCH subsection 2, then 80 JJAA for individual. These three only available. If it is like companies, other than these three, okay, 80 CCD subsection 2, 80 CCH subsection 2 not applicable to companies, but they will get 80 JJA, 80 M deductions, and even sometimes 80 LA deductions also. Okay, so chapter 68 deductions available under new regime, not available. But whereas old regime, sir, he has deposited in PPF 2 lakhs, so 80C 1,50,000 is allowed, and medical insurance premium paid 30. He is a senior citizen? No, he is not a senior citizen. So how much is allowed? 80C 1,50,000 deduction available, 80D 30,000 is 25,000 is allowed. So if you claim the chapter 68 deductions also, the net total income here it would be 52,70,000. Here it is like 49,50,000. Okay, now we should calculate tax. Sir, under new regime, first 15 lakhs, how much is the tax, sir? 1,40,000. Then the balance how much is there? 37,70,000 into 30%.
Total tax 1 lakh.
No.
12,71,000.
Yes, the total tax here is like 12,71,000. Here it's like how much? 49,50,000. On first 10 lakhs 1,12,500. Balance 39,50,000 into 30%. If you do, then the tax is like how much? 13,200,000.
12,97,000.
Sorry. Okay, so this questions are compared to the previous question, this is like little more easy to solve only. Okay, the twists and turns also little less. Okay, so student may do mistake regarding the income from house property, sir, especially that under default regime the loss from house property is not eligible for set off with other heads. Okay, so you can claim interest as deduction, you can claim standard deduction, but the loss from house property can't be adjusted with other heads. Within the head you can adjust. Okay, and one more thing, sir, I am saying, if it is a self-occupied property, then interest deduction is not available under default regime. If it is a self-occupied property, let out property, interest is allowed as deduction, but it is not eligible to set off with other heads, whereas under the old regime it is eligible for set off. That is one thing. Then deductions, mostly people will know, because if you read deductions chapter there is nothing great here. Then anything else, no problem, sir. The question is like a simple question only. The only thing is like house property related mistake you might do. Okay, then we are moving on to the next question, sir. Question number 20. This is a December 24 exam question. What is the year? Palam Limited, Delhi is a domestic company engaged in the manufacturing activity. The following details are related to the financial year. Okay. What they are asking? They are asking us to find out, suggest the company as to whether it should opt for the regular provisions or 115 BAA in order to minimize its tax liability on the assumption that it has satisfied all the applicable conditions. See. What is the gross revenue from operations, sir? 80 lakhs. Manufacturing expenses, yes, they need to be subtracted under both the regimes. Then normal depreciation, yes, allowed under both the regimes. Additional depreciation, sir, normal regime na it is allowed, whereas under 115 BAA it is a special regime na, so it is not available. Then the company is eligible for deduction under 80IA and 80JJAA. Okay, so 80JJAA, 80JJ is about what, sir? Additional employee cost. So this is available under both normal regime as well under 115 BAA also, whereas 80AA is available only under the normal regime and it is not. Okay, okay, so 80JJ, 80IA is not allowed under what? 115 BAA. Okay, whereas this is the eligible. The company turnover never exceeded 400 crores. So that means even under normal provisions also the tax rate remains what? 15%. So quickly, sir, once I will show you what is the 115 BAA provisions. Sir, 115 BAA provisions are applicable only to a domestic company. When they opt for 115 BAA, the tax rate is like only 22% plus surcharge at a rate of 10% plus cess at a rate of 4%. Okay, sir, just like as under 115 BAB, here there is no separate tax rate for other head income and PGBP income. Okay, irrespective of whatever the income, the tax rate is like 22%. If there are special rate incomes like 112A, 112 and 111A incomes, those are chargeable at special rates only, and surcharge is common 10% irrespective of their total income. Okay, so quickly, sir, we'll solve this question also parallelly. So what is the revenue from operations, sir? Old. Okay, we'll take like default or old regime, and even we'll take what? New regime also. Okay, so what is the revenue from operations under both of? This is for what? Company. For companies. Okay, old regime is only the default. Okay, revenue is how much, sir, in both the regimes? 90 lakhs.
80 lakhs.
80 only, yeah, sorry. 80 lakhs. From there, we should subtract expenses. Which expense first? Manufacturing expense. Subtract 30 lakhs under both the regimes. Then, okay, we need to subtract what? Normal depreciation under the both the regimes. Normal depreciation. Okay, 7 lakhs subtract under both the regimes. Then additional depreciation is not eligible under the, okay, additional depreciation is not eligible under the new regime, only available under the old regime. How much, sir? 2 lakhs. 2 lakhs. Yeah, nothing. So what is, okay, this is all right. Okay, then what is the PGBP income, sir? Okay, if you subtract 39 lakhs, it would be how much? From 80, if you subtract 39 lakhs, it would be 41 lakhs. Okay, whereas here it would be 43 lakhs. Then we should go for chapter 6A deductions. Sir, chapter 6A deductions are under new regime, old regime, default regime, both are available, 80AA and 80JJA. Whereas under old regime, 80IA is not available. Not available. So how much is 80IA deduction, sir? 5 lakhs. How much is the 80JJA deduction, sir? 4 lakhs.
Sir, there is.
Here also 4 lakhs. So if you subtract these, what is the
42 lakhs.
net total income, sir? 41 minus 9. The net total income is 32 lakhs. Here it is like 39 lakhs. So this is what? This is the net total income. On this we need to calculate tax. What is the tax rate, sir? On 32 lakhs, 25%. How much?
8 lakhs.
8 lakhs. Okay, why? Here tax rate is like 25%. On 39 lakh 60,000 into 22%.
39,000. 8 lakh 58,000.
8 lakh 58,000 is the tax. Then surcharge. Surcharge is not available here, sir. Here 10%. So 85,800. plus cess at a rate of 4 percentage. 8 lakhs into 4 na 32,000 here, whereas here 8 lakh
81,552.
8 lakh 32,000 here, the total including cess
Yes, sir.
how much? 9 lakh
9,81,552.
552 rounded off to 550.
Yep.
Okay, so which option is better, sir? The normal default regime is only better, the old regime, okay, instead of the new regime. Okay, I hope you're getting this point also, sir. Question number 20 also done. Then now we are moving on to question number 19. This is also exam question only, sir. Question number 19. Okay, see, Anand, an Indian resident. See, if you look at the flow, sir, December 24 and June 2024, 3B they are asking from company's perspective, 3A they are asking from individual perspective. Okay, sir, it's not like it's gonna happen in the same way, but at least some kind of prediction if you do, that can be there. I mean, you be safely prepare those provisions for that particular question. If it works on our way, then easily you can secure exemptions, right? Why to miss that chance? Anand, an Indian resident, aged 52 years, gives the following information for the year ended. Income from manufacturing business as per P&L account. How much, sir? 10,60,000. Depreciation as per books 56,000. As per Income Tax Act 77. Additional depreciation 11. Loss from speculation business 1,25,000. PPF 1,50,000. Medical insurance premium 35. Compute the total income as per both default regime and the old regime. So I am taking default as well as old regime. So what is the P&L, sir? Income. So they are having profit as how much? 10,60,000 under both the regimes. 10,60,000 here and here also 10,60,000. Then we are having depreciation. Sir, as per books, whatever is the depreciation is there, what we should do? Add back. Then we should subtract first normal depreciation, sir. Additional depreciation will do separately. How much is the normal depreciation, sir? If you subtract additional depreciation 11,000, 66,000. So 66,000 is available under both the regimes. But additional depreciation is available only in the old regime. New regime it is not available. Okay, additional depreciation 11,000. So don't confuse about default regime, sir. In previously default regime you given, sir, for companies default regime is old regime. For individuals default regime is like new regime. Then this is also done. Then loss from speculation business. Can loss from speculation business be set off, sir? Loss from speculation business has to be set off only with the gains from speculative business, even under old regime as well as under new regime. So you will just skip that part. So what is the income under that PGBP for you?
10,50,000.
Here 10,50,000. Here
10,39,000.
10,39,000. Okay, this is the PGBP income. Are they having any other income, sir? No. So that itself is what? Gross total income also. From there we'll go for what? Chapter 6A deductions. What are the chapter 6A deductions available, sir? PPF 1,50,000 ATC and medical insurance premium 52 na, age 52 only, sir, only 25,000. Okay, but that is not available under the new regime or the default regime. So ATC in old regime 1,50,000 and ATD 25,000. If you subtract, what is the?
8,64,000.
This remains 10,50,000. Here it is like 8,64,000. So now you should compute the tax under both old regime as well as new regime. Sir, old regime and new regime 10,50,000, sir. So for under new regime, sir, 0 to 3 lakhs nil, 3 to 7 lakhs how much? 20,000 5%. 7 to 10 lakhs it is like 10% na 30,000. Then on the balance 50,000 it is like 15%. How much? 50,000 into 15% na 7,500. So what is the total tax here? 57,500. Correct only na?
Yes, sir, into 4%.
Okay, plus cess 4%. How much?
Total tax 59,800.
That means here 2,300 is the cess.
And
Then
next 88,712.
88,712 is the tax. So which?
Up to 70.
Okay, which is better, sir? New regime or the default regime is only better in this option, in this particular question. Okay, so we have got this point also, question number 19. Then we move on to question number 18, sir. This is which attempt question, sir? June 2023. We discussed December 24 and now we are moving on to what? That might have been a repeated kind of question, that's why not included. Okay. So now see here, sir. What is question number 18, right?
Yeah.
Following are the details of income of Chaturvedi for the previous year 24-25. Salary income before standard deduction 8,20,000, self-occupied property loss 2,20,000, then interest on FD with Canara Bank 1,10,000, savings bank interest 20, then RPF recognized provident fund 1,20,000, housing loan principal repaid 80,000. So compute the total income and tax liability of Chaturvedi under regular provisions and section 115 BAC. So first, okay, regular as well as default regime as well as the old regime. So default regime. Sir, under default regime for salaries, how much is the standard deduction available, sir?
25,000.
Okay, so let me solve it, sir, again for you. Okay, so we'll be taking what? Default regime as well as old regime. So what is the total salary income available, sir? The salary income available is like 8,20,000, 8,20,000. Sorry, I'm taking not the net amount, sir, the gross amount 8,20,000. From there, standard deductions are available.
75,000.
So the standard deduction under the new regime is like 75,000, whereas under old regime it is only 50,000. So the net income from salaries would be how much, sir? Here it is 7,70,000 under the old regime. Here it is like 7,45,000 is the income from salaries. Okay, done. This is done. Then if you go, sir, next self-occupied property. Sir, the loss from self-occupied property is not eligible for set off under the new regime. So loss from self-occupied property. Here not eligible, sir, not eligible for set off. Here you could set off up to how much? 2 lakhs. Even the 2,20,000 inter-head set off is possible only to an extent of what? House property loss 2 lakhs only. Okay, then they have IFOS income also. IFOS income they are having how much, sir? They are having like savings bank interest and even FD interest also. Together how much, sir? 1,30,000. Okay, so I am straight away taking IFOS 1,30,000. Here also 1,30,000. So let me find out the gross total income, sir. How much? 7,45,000 plus 1,30,000 na 8,75,000. Here it is like 5,70,000 plus 1,30,000. It is like 7 lakhs. 7 lakhs. This is what? Gross total income. Then deductions. What are the deductions available, sir? They have RPF contribution and even housing loan principal repaid. So both together are eligible for what? ATC deduction, but only under old regime. And then is he a senior citizen, sir? No, he is not a senior citizen, but still he is eligible for 80 TTA deduction up to 10,000. So now chapter 68 deductions only available under the new regime. ATC, 80 TTA. Okay, new regime not available. Old regime how much?
10,000.
1,50,000 ATC and 10,000.
10,000 TTA.
Okay, so then if you subtract this, new regime the total income will remain 8,75,000 only, but here, whereas here it would be 5,40,000. Then tax you should calculate, sir. Again, tax I am not doing always. That's the basic thing only, right? It's okay. Okay, the taxes if you see also in the answer, in one option it coming to 39,000, in another option it is like 21,320. So obviously old regime is only better. Old regime is only better. Then question number 17. Question number 17. So this is like make or buy question. This is from our workbook. So these kind of questions actually you only know better than me. You should only know better than me. Okay, sir, here there is a correction in the material. What? Here it would be wrongly mentioned as 8,40,000, but you should correct it to 5,40,000. And here also, sir, old regime you should correct it, like here it's not 10 lakhs, it is 7,10,000 and 1,30,000. Okay, so what we did here is only correct. In material if you are there any mistake now, please correct it. Then make or buy. ABC Limited is evaluating whether to manufacture a component in-house or purchase it externally if ABC Limited decides to manufacture. If ABC Limited decides to manufacture, it must purchase a second-hand machine for 10 lakhs, 5-year life. Manufacturing costs for 5 years are like 15 lakhs, 18 lakhs, 21 lakhs, 24 lakhs, 27 lakhs. And depreciation is at 15%. WDV is like 1 lakh 50 at the end of 5th year. If ABC decides to buy externally, so it has two alternatives. One, it can manufacture internally. The other thing is like it can just purchase that particular item. Purchase cost is like 20, 22, 24, 26, 30. Tax rate 32.45 and discount rate is like 14%. Okay, so this is more of like an FM question, sir. You only know better than me. I just try to explain you, sir. You just need to solve. This is not even tax actually. See, ABC Limited is evaluating whether to manufacture a, okay, see, first make the product. Sir, we'll see what is happening in the making the product. Sir, when they make a product, first they need to incur in year 0 10 lakhs because they need to purchase the machine. So the cost for them is like cash outflow is how much? 10 lakhs is there. Year 0 10 lakhs outflow, present value annuity factor 1 and the total present value of outflow is also 10 lakhs. Fine. Then from year 1 onwards they will be incurring 15, 18, 21, 24, 27. So they have taken 15, 18, 21, 24, 27. Okay. But on this manufacturing cost, sir, okay, every year we gonna get depreciation also. Because on this 10 lakhs we gonna get what? Depreciation every year. So with respect to depreciation we gonna have a tax saving. Okay, because this is gonna reduce our profit now. That's why depreciation is how much? 1 lakh 50, 1 lakh 27,500, 1 lakh 8,375, 92,109, 78,300. Okay. Then we are having a tax saving. Sir, what is the tax saving? How we arrived this tax saving, sir? This tax saving is nothing but manufacturing cost plus depreciation. I mean manufacturing cost plus depreciation into what is the tax rate they given in the question, sir? 32.445%. 32.445%. If you do that, you will get 5,35,343. Okay, so because you are debiting these expenses to P&L now, so once you debit your profit come down, you will be tax saving. So every year you have a tax saving like this. So the net cash outflow, sir, again, so what again the mistake you do is like you will take manufacturing cost plus depreciation minus tax saving as cash outflow. Wrong. Why? Depreciation is a non-cash expense. So depreciation will consider only for tax saving, but to find out real cash outflow, depreciation will not consider. So what is the real cash outflows? Are 15 lakhs minus tax saving 5,35,343 na. So cash outflow is what? Manufacturing cost minus tax saving. Then 9,64,658. So for every year you will do the cash outflow. Okay, and in year 5 you can sell that old machine for a scrap value of 1 lakh 50. So you have a inflow also 1 lakh 50, that also taken. Then you are discounted with the present value factor by finding out at 14%. Sir, how do you get present value factor, sir? 1 divided by 1.14. If you press for one time you will get 0.877, 2 times 0.769, 3 times 675, 4 times 592, 5th time 0.519. So then if you multiply, you will be getting total cash outflow in this option 54,81,657. There is a second option also, to buy. Sir, if you buy a product, then it will be easy to solve, sir, because there is no depreciation also. Okay, only from year 1 there is outflow. How much? 20 lakhs. These are expenses only. 20 lakhs, 22, 24, 26, 30. Okay, take them. Then straight away tax saving on it. How much? This purchase cost into the 32 point something percentage is there na, apply. Then cash outflow, straight away subtract purchase cost minus tax saving. You have 13 lakh 51,100, 14 lakh 86,210, 16 lakh 21,320, 17 lakh 56,430, 20 lakh 26,650. Then present value factors if you take and multiply, then you will getting the total present value as how much, sir, of outflow? 55 lakh 15,637. So which option gives you better, okay, least cash outflow? the first option will be, okay, when you manufacture on your own, it gives you the least cash outflow. Since the present value of cost is low in manufacturing the component compared to the buying, the company should opt for the make option. For the make option. Question number 17 is this. 10. Then we are moving on to question number 16. See question number 16. XYZ Limited wanted to acquire a machine costing 1 lakhs. Depreciation rate is 15 plus additional depreciation 20. Okay, that is only in the first year. Tax rate is 34.944. Weighted average cost of capital is 10. Machine has life of 5 years. Loan 75,000 can be availed at 9% interest payable annually, with principal repayable at the end of 5th year. Alternatively, they can even go for lease at 34,000 per annum for 5 years with a lease management fee of 1,000 payable at inception. So again, two options, sir. Okay, what are the, okay, here sir, three options, sir. First one is what? They could only buy the machine or with their money. Second option is like what? They can take a loan and purchase machine. Third option is like what? They can completely lease the machine. So three options we need to solve. First one, cost of acquisition if own fund is used for acquisition. How much is required? 1 lakh. So there is a cash outflow of how much, sir? 1 lakh. Okay, see. They are charging depreciation, sir. On 1 lakh, first year, what is the depreciation? Normal depreciation plus additional depreciation. Together, there will be 35,000. And subsequent year onwards, 65,000 into 15%, 9,750. On written down value methods, if you calculate, you will get these depreciations. But these questions are, if you listen and if you put tick mark along with me, this is not watching and verification. Okay, if you really need to learn these questions, what you should do? You just pause the video and try to solve. Okay, there is nothing tax here. From your SFM knowledge, from your inter-level FM knowledge, these questions you could solve already. Better than me, you should solve. Okay, tax shield. How much is the tax benefit on this? 34.994%. So present value. Okay, so this is what the present value of tax shield. The present value of tax shield. How much, sir? 19,091. So you will have a outflow of 1 lakh. But because of this depreciation on the tax saving, okay, overall you will get 19,091 saving. Okay, so from 1 lakh cost, because of tax saving and that also discounted to present value, you will have only net cash outflow of 80,909 in this option. But if you finance it with loan, sir, then two things. You will have interest expense as well as depreciation also. See, if financed via loan. Interest. Sir, why interest? Because they are taking only 75,000 as loan. So if they take 75,000 as loan, every year they need to pay how much? 6,750, 6,750, 6,750 as interest. First year they pay 25,000 and fifth year they are paying 75. Okay, this is the total cash outflow. On lease payment, okay, sorry, on the loan, 25,000 is the down payment and 75,000 is the repayment of loan. On down payment, nothing benefit you will get only depreciation. Okay, so 6,750, 6,750, 6,750. Okay, here in this year, the total outflow is like how much? 81,750. So if you see the outflow after tax, so what they are doing, they are not calculating the tax benefit here for this 6,750. So this 4,391 is what? After tax benefit. So 6,750 minus, we should do what? 34.944%. Sir, we want the total cash outflow if you finance it through loan. Total cash outflow. Sir, in first question, why we didn't it? Because in first question, year 0 only you are paying total 1 lakh. But here you are not paying in year 0. You are paying some part in year 1, some part in 5th year, and every year you are paying even interest also. So that's why net of interest after tax saving you are finding out, and the loan and the down payment made and the loan payment which is made after 5th year discounted to present values after tax saving. So 6,750 minus 34.944, if you do 4,391 is the interest real expense after tax saving, plus the original down payment made 25 and the loan repaid. Okay, if you all discount them, then the total will come to how much, sir? The present value of outflows is 88,270. But here in this particular table, we didn't consider depreciation. Why? So depreciation point remains same only, just like as option 1. How much is the depreciation related tax saving? 19,000. If you subtract that 19,091 here, the net cash outflow in this option is only 69,126 of present value. Present value. Okay. Then option 3. Cost of acquisition if it is taken on lease. If it is taken on lease. So if it is taken on lease, first year 0 they need to pay 1,000 and every year they need to pay 1,000. So year 0 1,000 and every year 34, 34, 34, 34. On all these, lease related can be claimed as expense. If it is claimed as an expense, profit reduced, will have a tax saving. So what is the tax shield? Multiply with this 34.9, that percentage is there na, 34.944. Okay, subtract. So the net cash outflow we got. Present values you discounted. So what is the total cash outflow? 84,481. So do we need to subtract depreciation? No. Why? This is lease option. You are not the owner of the asset. You can't claim depreciation. So the total, there is no tax saving on depreciation for you because you can't even claim depreciation. So in this, the present value of outflows is what? 84,481. So which option is better, sir? The second option, 69,126 option is only better. Okay, this is question number 16. Then we are moving on to the next question, sir. Question number 15. Question number 15. Sure Success Limited wants to acquire an asset covering 1 lakh. It has two options are available. The first one is buying the asset by taking a loan repayable in 5 installments, of which 25,000 each with 14% interest per annum. First one is like the buying the asset by taking a loan and it has to be repaid in 5 installments with 14% per annum. The second is like taking it on lease. Every year they need to pay 30,000 as lease rent. Okay, the lessor charged 1% as a processing fee in the first year. Assume that the internal rate of return to be 10%. Okay, first alternative one. What is the alternative ones are here? Purchasing an asset. Okay, so when they purchased an asset, how the installments has to be paid? Every year 5 installments. No? So every year they are paying 20,000, 20,000, 20,000, 20,000, 20,000. On this again interest is applicable. What is the interest, sir? Interest at a rate of 14%. Interest at a rate of 14% per annum. So if you see, first 1 lakh 14,000, then on 80,000, then on 60,000, 40,000, 20,000. Okay. Depreciation because they own the asset. First year 15. Sir, we don't know whether it is a manufacturing entity or not. That's why we didn't consider additional depreciation. 15,000 first year, second year 12,750, third year 9,000, 10,838, third year depreciation, fourth year this one. Sir, now tax saving. Sir, tax saving is not available on the loan principal repaid because that is not an expense. Whereas interest and depreciation is an expense which will be debited to P&L, which reduces our profit. So on these two we'll have tax saving. How much, sir? 33.82. So 9,634 is the tax saving. So we should find out real cash outflow. 20,000 we have cash outflow first year, plus interest 14,000 we have. Depreciation is a non-cash item, ignore. Minus tax saving 9,634. If you do, you will get how much, sir? 24,366. So A, installment paid. B, interest minus tax benefit. Don't add depreciation part because depreciation is a non-cash item. So if you do, you will get the net cash outflows 24,366, 23,244 for all these years. Then multiply it with the present value factors. Okay, then you will get the total present value 83,985. 83,985. Then it is assumed, sir, because after 5 years they didn't given the salvage value. So we assumed like the salvage value is 0. So we didn't subtract it. Then acquiring an asset based on lease. So what is the lease one, sir? The lessor charged processing fee as 1% in the first year and every year they will be paying 30,000. So if you see 0, 1,000 and 1, 2, 3, 4, 5 every year 30. So on the total amount it is expense only. So every year there will be tax saving of 33.22%. If you subtract the tax benefit, net cash outflow is like 2034, 2034, 2034, 2034, 2034. Discount it, you will get 76,611. So when in the buy option you have outflow of 83,985, whereas in lease option you have outflow of 76,611. Which is better? Leasing Taking the machine on lease is only better. Taking the machine on lease is only better, right? It's okay. So question number 14. Sir, 14 and 13 both are related to salaries question, sir. Okay. So final level, sir. Whether you do CFNL, whether you do CMFNL, wherever you do, usually if these questions are asked, then it's a bang only. Suddenly if you go to the exam, sir, the previous questions and all, at least we can try without prior knowledge. But these questions, salaries, nobody will even know. And that also, did they ask about standard deduction like 1 or 2 points or no? So my gut feel is like, they'll not ask question from this salary. That is too harsh to ask a question on a salary. We are not inter-level students. We will not be studying that also. But if at all they ask, there are like these two are like model question paper questions only. This is December 23 MQP and this is like December 24 NQP. So if they ask also, my feeling is like they'll ask only these questions, MQP questions. So we cannot, okay, there is such risk if we ask on a new point, but ignore it. Okay, if at all, trust me, if they ask from salaries, it would be from these questions only. So at least you learn these questions, it would be enough. First one, Mr. Gopal is a salaried employee who submits his particulars for 2 financial years, 22-23, 21-22. Basic salary 10 lakhs, here 7 lakhs, DA 2 lakhs, 1 lakh 80, HRA 4 lakhs, 4 lakhs, rent paid 3 lakhs, 3 lakhs. Arrears of salary, what does it mean by arrears of salary? Arrears of salary, this is related to past years but received in the current year. So that means this may be related to 21-22. Okay, this is related to 21-22, but it is received in which year? 22-23. Sir, someone might be saying like, sir, salary is taxed on due or receipt basis, sir. So it might have fallen due in 21-22 only. So it might have taxed in 21-22, No. Arrears of salaries, what does it mean? Means sometimes these government companies and all will revise the pay scale. I mean, they'll revise the salaries. When they revise the salaries, they'll do it with retrospective effect. So from a past 1 year, past 1.5 year, they'll revise retrospectively. So that time, okay, in the past when you are computing, that was not even became due, because by that time salary is not even increased. Now they are increasing with retrospective effect. So due also became now, receipt also became now only. So that's not due in previous year, not taxed in previous year. So now 3 lakhs has to be taxed. Okay. But when there is an arrears of salary, there is a relief under section 89. What does it says now? So the problem, understand the relief. Sir, if this arrears, if they were known in the previous year only, these are related to a preceding year, if this is included in the preceding year only, then they might have enjoyed a lower slab benefit, this income, or might have enjoyed some other benefit which is there in that year, not available in the current year. So because of this person might be ending up paying higher tax now. That's why relief under 89 is provided. What does it say? For this, sir, you need to do, actually for 2 years you need to calculate now. For this 2 years you need to do 2 times. What? Include this 3 lakhs and do once the tax calculation for 21-22. Without this 3 lakhs also do for 21-22. Then for 22-23 also. With 3 lakhs do once, without 3 lakhs also do once. Okay. Then LIC paid 65,000, 63,500. You are required to calculate the amount of exemption in HRA, amount of deduction and amount of relief in respect of areas respectively. Okay. Sir, here we'll see. What is the basic pay, sir? 10 lakhs.
10 lakhs.
Okay. For every year we are doing 2 times, sir. Why? Because that with arrears, without arrears. 21-22 also. With arrears, without arrears. 7 lakhs, 7 lakhs. Then DA. So DA also fully taxable allowance. So DA, what you should do? Add 2 lakhs, 2 lakhs, 1 lakh 80, 1 lakh 80. Okay. Then HRA, sir. HRA, how much they got? 4 lakhs and 4 lakhs. But HRA is having an exemption. Sir, assuming we are following what regime? Old regime only. We are following old regime only, not the default regime. In new regime, HRA exemption not available. Okay. So what is the HRA exemptions are here? HRA is exemption. Here did they mention as metro city or non-metro city, sir? No. So we'll take it as a non-metro city. What is the HRA exemption? Actual HRA, rent paid minus 10% of salary or 40% of salary, whichever is lower. Actual HRA, rent paid minus 10% of salary or 40% of salary. Out of these three, whichever is lower is given as exemption. Then salary definition for the purpose of HRA. Salary means basic plus DA forming part of retirement benefits plus commission paid as a fixed percentage of turnover. Here commission is not there. We are having only basic plus DA. So what is the basic plus DA, sir? 10 plus 2 lakhs, that equals to 12 lakhs. Okay. 10 plus 2, sorry, sir, DA is not fully forming part retirement benefits, only forming part. 1,50,000 here we should take,
10 lakhs.
1,83,000. So if you take tax, the salary is like for HRA 11,50,000 only, because 10 plus 1,50,000. Whereas here you should take what? 45. Okay, if you subtract 45 from this, 1,35,000. Okay, 1,35,000 and 7 lakh, it will become what? 8,35,000. How we got? Salary, basic plus DA forming part of retirement alone we take. Okay, then HRA exemption. Actual HRA 4 lakhs, 4 lakhs. Then rent paid. What is rent paid, sir? What is the rent they paid? 3 lakhs, 3 lakhs. Minus 10% of salary na, salary 11,50,000. 3 lakhs minus 10% of 11,50,000 if you do 1,15,000. 3 minus 1,15,000 you will get 1,85,000. Then here 3 minus 10% of 8,35,000 83,500. 3 minus 83,500, it will come to 2,16,500. Then 40% of salary, 11,50,000 into 40 and 8,35,000 into 40. So out of these three, whichever is lower. So first year 1,85,000 is exemption. So not first year, for 22-23, and for 21-22, 2,16,500 is the exemption. Okay. Now what we need to take in the statement, we need to take taxable HRA, not exempted HRA. How do we find out taxable HRA? From the total HRA received 4 lakhs, you subtract exempted 1,85,000. Then what is the taxable HRA? 2,15,000 is the taxable HRA. So that only they taken in the question, taxable HRA. Okay, for the preceding year, 2,16,500 is exemption, whereas 4 lakhs is the actual HRA. From there, if you subtract 2,16,500, you will get taxable HRA 1,83,500. Okay. Then for arrears, sir, you will include arrears without arrears, and for the past year also with arrears, without arrears. Then you got gross total income, gross total incomes, and then we have subtracted standard deduction. So don't again argue with me stating like standard deduction is 75,000. Sir, here we are into which regime, sir? We are into old regime. So standard deduction available is 50,000 only. Then subtract net total income. Okay, this is the net total incomes. Then EDC deduction. How much is the EDC deduction available, sir? 65,000. What did it? We have life insurance premium 65,000 and 63,500. Subtract them. Then you got net total income, and on the tax 3,04,200, 2,10,600, 1,95,000, 1,06,600. So now what we should do now? Sir, for 21-22, okay, see here, 21-22, two options. With arrears, what is the tax? And without arrears, what is the tax? With arrear, without. With arrears, what is the tax, sir? 1,95,000. What is the tax? 1,95,000. Okay. Without arrears, what is the tax, sir? 1,06,000. So if at all it was taxed in 20, the arrears is also taxed in 21-22. On the arrear part, how much extra tax he might have paid? 1,95,000 minus 1,06,600. How much? 95,000 minus 1,06,600.
88,400.
So if it is included in 21-22, he might have paid extra 88,400 only for arrears. But then it was included in 22-23. If it is included in 22-23, again we should do with arrears, without arrears. So now tell me, with arrears, what is the tax?
600.
3,04,200 is with arrears. 1 second, sir. Okay, so then with arrears, how much are here? With arrears 3,04,200 Without arrears, how much, sir, here? 2,10,600. So you just find out the difference between.
93,600.
How much?
93,600.
So understand, sir, the 3 lakhs by including in 22-23 we are paying extra 93,600. If it is included in 21-22 only, we will pay only 88,400. So including it in 22-23 is, I mean, then we need to pay more tax. But there is no other option. Already 21-22 is completed. That's why how much extra you are paying, find out.
5,200.
5,200 extra. So this extra they will give as relief under 89 subsection 1. Okay. So if you subtract this relief 5,900 or 5,200.
5,200.
So that 5,200 if you give it as relief, then 3,04,200 minus 5,200 you will be paying 2,99,000. Okay. But don't cry, sir. Inter level itself we have left a salary, sir, or else somehow we did question, sir, but now also again this is not leaving. What to do? Until we clear CMA, these hurdles are everywhere. But understand, sir, just because a question you felt little tough, never give up. Okay, don't skip this video saying like this salary questions and all, why I will do and all. Okay, so mostly, sir, this video is gonna come for 2 hours only now, this tax planning chapter. 2 hours if you give, I am solving each and every question now for you. There is no theory to discuss here. Okay, wherever you go, you will find only these questions maximum. So for 14 marks, 2 hours only we are asking, right? If you do it now, then on the day before exam, okay, sorry, again, day before exam, can we select questions? Sir, see, till now this many questions we solved. Does any model of question has been repeated? No. A part may be repeating, but mostly again the question is changing. So how can we do selective question? So day before exam you cannot solve. Okay, now you solve. Day before exam you just see the critical adjustments and all, that alone will be checking once again. Okay, now question number 13. Ramesh, who is neither a director nor has a substantial in company, is offered employment by Freewheel Limited with the following alternatives. He has basic pay 60,000, 66,000, bonus 9,000, 9,000, education allowance for 2 children 32,200. Sir, education allowance, sir, new regime no exemption is available, but old regime 100 per child. Okay, max 2 children, 100 per month, maximum 2 children is allowed as exemption. Then education, the other option is like education facility for 2 children in school maintained by employer. Okay, then sweeper allowance fully taxable, sir. Sweeper allowance fully taxable. Sweeper facility is also fully taxable. Entertainment allowance fully taxable. Club facility is also fully taxable. Transport allowance for personal use also fully taxable. Here free car is provided, sir. Motor car perquisite we need to find out. Medical allowance fully taxable. Medical bills reimbursement fully fully taxable. One second, sir, let me show you. Okay, we'll see. Then allowances for gas, electricity and water supply fully taxable. Then this is also fully taxable. Holiday allowance fully taxable. Holiday home facility is also fully taxable. Lunch allowance fully taxable, but lunch facilities are per meal. If at all per day the meal is less than 50 or up to 50, it is what exempted. Gift allowance fully taxable, whereas gift given up to rupees 5,000, out of the 7,500, 5,000 is fully exempted. Okay, rent free unfurnished home, okay, is given as an allowance 14,000, here 14,000. So it is like available for what? Rent free accommodation perquisite. Okay, so whole salary chapter they tested, sir, allowances and perquisites. Okay, now see which of the two options are better. On the assumption that both employer and employee will contribute 10% of salary towards URPF. Sir, when they contribute towards URPF, that's not eligible for ATC deduction. They should have contributed to RPF. Then interest-free loan of 20,000 will be given to him for purchasing household items. Assume that he has opted for old regime. Assume that he has opted for old regime. So look at this question, sir. Ramesh, who is neither a director nor has substantial interest in any company, is offered employment by Freewheel Limited, Mumbai with following two alternatives. Okay, sir. Once again, I am revising the question, sir, because It's not about old and new resin, it's about option 1 and option 2. In option 1 they are giving it as an allowance. Sir, what is the difference between allowance and perquisite? Sir, if they give me 500 every month to use mobile, then mobile allowance. They are directly paying the mobile bill. They taken a postpaid connection, whatever the bill comes they only paying, then that is a perquisite. Understand? When they give it me as a facility, I need not to think of, I need not to pay for it. The company will only pay or the employer will pay, then that is a perquisite. Okay, whereas they'll pay me a fixed amount, okay, irrespective of how much I spend. For mobile I may spend 2000 or 500, but they fixedly pay 500 only, then that is called as an allowance. Okay, so option 2 they are giving perquisites. So you need to think which is better, which alternative is better. See, basic pay in both options taxable, bonus 9000, education allowance, whereas second options are the given education facility. For education allowance 100 per month up to 2 children is exempted. How much, sir?
2400.
Okay, 2400 exemption is here. But if it is given as an education facility, then per student, if they are studying in the school maintained by employer only, up to 1000 is exempted per child. So how many children are? Maximum 2 children. So 1000 per child into 2, okay, into 12 months, 24,000 is exempted. So you should subtract 24,000 here. Okay, so I am writing what is the taxable one here, sir? 30,200 minus 2,000. Okay, that
6200.
here 6,200, whereas under option 1 it's like,
Option 1, 30,200 minus 2,400. 27,800.
so here it is like 27,800. So this point, sweeper allowance fully taxable and sweeper facility is also fully taxable, so nothing to be taken in both options. Entertainment allowance fully taxable, club facility is also fully taxable. Transport allowance for personal use, sir, with respect to transport allowance, sir, there is no exemption unless he is a disabled child. Okay, disabled.
21,600.
So it is like fully taxable. Then free car facility for performing journey between office to home and vice versa, car owned by employer. Free car facility for performing, so motor car perquisite, sir. So the motor car perquisite, if it is completely for official purpose, then it is not a perquisite. Okay, owned by employer. If it is completely used for official purpose, then it is not a perquisite. If it is used for personal purpose, then only we should take perquisite value, that 1600 per month, chauffeur salary 900. Okay, that is not here, completely it is used for official purpose only, so it is completely what? Exempt. Then medical allowance fully taxable, medical reimbursement is also fully taxable. Then allowance for gas water supply fully taxable, this is also fully taxable. Holiday home allowance fully taxable, facility is also fully taxable. Lunch allowance fully taxable, but see here, sir, lunch facility, sir, per day up to 50 per meal is exempted. Okay, so total how many days are there? 250 days. 200 plus 50, 250. But 250 into 50 is exempted.
12,500.
So 12,000 is exempted. So 12,500 is exempted. So 5,500 is only taxable. Then Diwali gift allowance fully taxable. Gift provided, sir, 5,000 is exempted. If any gift is given, 5,000 is exempted. Then what is the taxable one, sir? 2,500. Then rent free accommodation provided. Okay, that is also taken on lease. Sir, if rent free accommodation is provided by employer which is taken on lease, how much is the exemption, sir? Actual lease rent or rent paid into, sir, this option same for both options, they given it as a perquisite only. Rent paid, sorry, actual lease rent or 10% of salary. 10% of salary. Sir, salary definition for perquisites is different. What is the definition of salary? The salary includes bonus salary plus all the taxable allowances. So usually, sir, you should remember it as a format: salary, bonus, commission, then you will take all the allowances, then perquisites. So above perquisites, whatever will come, all those you need to total. Okay, see, for the rent free accommodation, sir, in option 1 only allowances are there. In option 2 allowances are not there. So basic commonly taken, bonus commonly taken. Allowances are not there in the option 2, so nothing taken. Whereas in option 1, all this has been taken child education element, taxable part only, sir. Transport, holiday, medical, sweeper, entertainment, lunch, Diwali gift. So total here 1,96,400, here 75,000.
19,640. Allowances, 13% of salary.
Yes. But no problem now. That's not okay. So on this 10 percentage na 19,640, here 7,500. What is the exemption with respect to furnished accommodation available? Whichever is lower. This 14,000 or 19,640. Whichever is lower now 14,000. Here 14,000 or 7,500 na lower 7,500 is only available as exemption. Now see sir, the statement 66, 9. Children education allowance, they are given exemption and taken straight away 27,800 taxable. Transport allowance no exemption, taxable 21,600. Holiday, medical, sweeper, entertainment, lunch, gas, Diwali, everything taken as it is. Here on option 2, no allowances. Then rent free accommodation 14,000 or it's not 460, it is like 640 sir. Okay, but whichever is lower na, which is lower sir? 640. So sorry, 14,000. So that take it as exemption. So whatever they got, that is fully exempted. Whereas here 14,000.
7,500, which one is?
Sir, this is not about exemption, sir. Sorry. This is about how much we need to take it as the value of perquisite. Actual rent paid, lease rent paid, or 10% of salary, whichever is lower will be taken as the value of perquisite. So here the value of perquisite is how much? 14. Here the value of perquisite is like 7,500. Okay. Then car facility already said exempted. Education facility, sir, 30,200, but per month 1,000 per child exempted na, so subtract 6,200 is taxable. Sweeper facility taxable, club facility, club, holiday, medical facility. Then gift 5,000 exempted, so subtract 2,500 only there. Gas, water fully taxable. Lunch per day up to 50 is exempted na, so subtract that 5,500. Okay, then what is the gross taxable salary? 2,10,400, 2,10,000, 1,43,200. From the standard deduction 50. Why? Old regime, we are in old regime this is. Then taxable salary 1,60,400 and 93,200. Okay, this is the question about salaries, sir. Sir, this question, what is happening, sir? Shah is Surat offered an employee, Surat basic salary 55,000, other allowances are like DA, not forming part of retirement benefits 50,000, medical allowance 10,000 fully taxable, bonus being 1 month salary fully taxable. The company gives an Shah to an option. Sir, till now everything remains same. Okay, the company gives an option like what? To take rent free accommodation of 20,000 per month or to accept HRA. Shah joined the job with HRA and tax house in Surat at a monthly rent of 20. Analyze whether has made a wise choice, old regime. So either he can take rent free accommodation or HRA, but he already chooses to take an as a RFA. But we need to decide whether it is correct or not. First, both the places, sir, the basic is 3,33,000. Why? Sir, he joined only on 1st October. So how many months? October, November, December, January, February, March, 6 months. So 6 months, if you do 55,500 into 6 months, you'll get 33,000, 3,33,3,33. Then bonus, sir, he is gonna get 1 lakh month salary, but he only worked for half year na. October, November, December, Jan, Feb, March. So half month salary only. So 27,750, 27,750. Then DA. So what is DA, sir? 50,000 per month. 6 into 50, 3 lakh, 3 lakh. Medical allowance 10,000 per month, 60. HRA. The one option is HRA, other option is RFA. What is HRA exemption, sir? Actual rent paid minus actual HRA, rent paid minus 10% of salary, 40% of salary. If it is not a metro. Sir, they mentioned here Surat. Surat is not a metro city. KDCM, Kolkata, Delhi, Chennai, Mumbai. Only these 4 are metro cities. See, how much will be the exemption available, sir? Sir, salary for the purpose of HRA is like basic plus DA forming part of retirement benefits plus commission paid as a fixed percentage of turnover. Here only basic is there. There is no DA, they said like not forming part, need not to consider, commission is not there. So directly basic only you should take. Okay, so what is the actual rent paid, sir? Actual HRA received 1,20,000. 40% na 1,33,200. 40% of salary. Nothing but 40% of basic stipend. Then rent paid minus 10%. Rent they paid is how much? 20,000 into 12. 1,20,000 they paid. Okay. 1,20,000 only na. The rent paid is how much, sir? 1,20,000 minus 10% of salary. What is the 10% of salary? 33,300. Okay, minus 33,300, 86,700. Out of these three, whichever is lower na, which is lower? 86,700 is given as exemption. Actual HRA is 1,20,000. From there 86,700 if we claim exemption, taxable HRA is how much? 33,300. In this option you will not get RFA, so gross taxable salary is 7,54,050. Then we should do for what? Rent free accommodation. Sir, rent free accommodation, first look at the value of perquisite, sir. Rent free accommodation may be provided by government employer or even by non-government employer. If it is provided by government employer, the license fee will be given in the question, that will be taken as value of perquisite. Then if they given by non-government employer, we should take whether the accommodation is own accommodation or taken on lease. If it is taken on lease, actual lease paid or 10% of salary, whichever is lower is the exemption. If they own it, then based on population, if it is more than 25 lakhs, 15% of salary is the value of perquisite. Population 10 to 25, 10% of salary is the value of perquisite. Less than 10 lakhs, 7.5% of salary is the value of perquisite. So what is the salary definition here? I already said in the previous question also. Salary includes basic, bonus, commission plus all the taxable allowance. Basic, commission, bonus plus all the taxable allowances. Okay. Now what is the salaries are here? If you add all this above, 3,33,000, 27,750, 3,60,000 here given, it is like 4,20,750. So DA, okay, except for DA, sir, DA, and even in previous question also, DA they might have considered, okay, in previous question DA is not there, okay. DA we should consider only to the extent farming part. If it is not farming part, don't include. Except DA, all other taxable allowances you take, but DA only to the extent of farming part. So here totally not farming part, so don't take. So it will be 4,20,750. Okay, 4,20,750 into 10% or actual rent paid.
1,20,000.
Whichever is lower na, 42,075 will be taken as value of perquisite. So here it is 7,64,825 is the salary, whereas here 7,54,050 is the salary. Which is better, sir?
Option
1.
When he takes
HRA is only better. Then question number 11, sir. Smile Limited shifts its industry. Okay, so this question is relevant to capital gains, sir. So look at this question, sir. Question number 11. Smile Limited shifts its from urban area in Jaipur to a remote village in Rajasthan. In the process of shifting, the company sells the following assets to purchase new assets at its new place. So they are having cost of acquisition, sale proceeds, transfer expenses, cost of new assets, and land is acquired for 1 lakh. Cost inflation index, compute capital gains, and a scheme of tax planning. Sir, here actually when they transferred or when they sold, they didn't set. Assume if it is in previous year 24-25. Okay, and they acquired it during April 2023. Okay, so see, sir, the point is like the transfer should be happened within 1 year from this date. Why? Here this is linked to 54G exemption, sir. Let me explain you 54G exemption. When an industrial undertaking from urban area, it is shifting to non-urban area, okay, to encourage shiftings into non-urban areas, they are giving exemption. The capital gain arising on selling the assets in urban area will be exempted when they invest the whole net sale consideration in purchasing land, building or plant and machinery in non-urban area. Okay, sir, they didn't invest it fully, then in proportionate to the net sale consideration, however they invested, that only will be given as exemption. So similar to that of 54F exemption, right? But here the investment has to be made 1 year before the date of transfer and 2 years after the data, within 2 years after the date of transfer. Before na within 1 year, after na within 2 years. But if they invest acquired in April 2023 itself, if not in the same previous year, let's say April 23 they invested, but whereas if transfer is happened in May 2024 na, that investment is before 1 year, so then they will not be eligible for exemption. So the planning is what they should invest within the 1 year. Sir, in answer there will be a mistake. So see here, what is the sale consideration, sir? 30 lakhs, 25, 9 lakh 50. Transfer related expenses given in the question, subtract net sale consideration. Then what is the cost of acquisition? Sir, we are assuming it is before 23rd July 2024. Assuming it before 23rd July 2024. Then we'll get cost of acquisition or indexed cost of acquisition. What is the cost of acquisition or indexed cost of acquisition? For building and plant and machinery, indexation is not available. Why? Those are depreciable assets. For depreciable assets, indexation benefit is not available. So only on land we have indexed. So it is 1,65,500, and for building, plant and machinery, you do the normal cost of acquisition only subtract. Then we got long term capital gains, okay, a short term. Why? Because on depreciable assets the resulting capital gain is always short term. Okay. Now did they invested? Yes, they invested how much? With respect to land 12, building 8, plant and machinery 4. Okay, so total investment made is 24. So in answer, they took the total 24 lakhs as exemption, and such 24 lakhs, first they adjusted with plant and machinery, and then with the building, and then with the land. Okay, 24 lakhs they claimed as exemption, but that is wrong. You can't claim 24 lakhs as exemption because they didn't invested the whole net sale consideration. So proportionate to the investment made out of net sale consideration is only eligible for exemption. So which is like here 11 lakh 33 131, 5 lakh 25 225, 2 lakh 8,815. Then the taxable is like this amount. Sir, this exemption, this is the amount taxable. This exemption is available only when they made the investment within 1 year or within 1 year before. Okay, if it is afterwards now, then this exemption is not available. Then they will be ending up paying more tax. Then sir, question number 10. Apex Limited is a widely held company, plans to expand its operation. It is evaluating 3 alternatives. What is like capital structure option? One is like alternative 1, share capital 60, alternative 2, 30, alternative 3, 15. Then 12% debentures, sir, they want to raise funds. Okay, and on that fund, how much they are earning, how much they are giving is also has to be checked. Alternative 1, they will go for share capital only 60. Alternative 2, 30 lakh share, 20 lakhs debentures, 15 lakhs loan. Alternative 3, 15 lakhs share, 12 lakhs debentures, 15 lakhs loan. So 20 lakhs loan. Then earnings before interest is like 18 lakhs, tax rate is 30, and dividend payout rate is like 20%. See, first how much is the earnings before interest they are having? 18. Sir, when they go for loans or debenture option, they need to pay interest now. Earnings before interest tax means we should subtract interest. How much is the interest, sir? 2 lakh 40. That means 20 lakhs into 12%. Here 3 lakhs, 25 lakhs into 12%. Then bank interest, bank loan, 10 lakhs into 15% na 1 lakh 50, 20 lakhs into 15% na 3 lakhs. So then we got EBT, earnings before tax, 18, 14 lakh 10, 12 lakhs. From there subtract tax. What is the tax rate? 30%. 5 lakh 40, 4 lakh 23, 3 lakh 60. So the profit after tax is like 12 lakh 60, 9 lakh 87, 8 lakh 40. Sir, the equity shareholders are expecting what return? 20%. Sir, here in question they mistakenly said it as like dividend payout rate. But in solution when they are solving, it was not taken as dividend payout rate. So dividend payout rate na from PAT they will be taking 20%. But here it is like, okay, the return they are expecting on return expected by equity shareholders. Okay, on equity share capital. How much are the return they are expecting? The return they are expecting is how much? 20%. So from there if you subtract 20% on their capital, how much? 60. 60 lakhs into 20% not 12 lakhs. In second option it is only 30, 6 lakhs. In third option it is only 15 lakhs, so subtract 3 lakhs. So after fulfilling all their needs, equity shareholder capitals, equity shareholders related 20% expectation, loan interest, debentures interest, after paying all that, the company having surplus money In alternative 1, 60, alternative 2, 3 lakh 87, alternative 3, 5 lakh 40. So in which option the company is having more amounts, sir? Third option. So the alternative 3 will only be better. Okay, so look at here, this note, correct it. Dividend payout has to be applied on PAT, but here it is applied on share capital. So that means it has to be taken as what? Return on capital. It is like return on capital. So even though it is mentioned as dividend payout, you have to take it as what? Return on equity share capital. Then question number 9. A business entity requires 50 lakhs. Okay, again 3 options: equity share, debentures, loan. However, they are expecting rate of return, how much, sir? 15%. Sir, what is the difference between previous question and this question? In previous question, they directly given EBIT. But in this question, they didn't given EBIT. They given what? Expected rate of return on the total capital employed. So, what is the expected rate of return, sir? See. What is the total capital employed in each option? 50, 50, 50. Okay. So, what is the earnings before interest and tax? Nothing but 50 lakhs into, okay, 7.5, 7.5, 7.5. Then in option 1, sir, only on 10 lakhs interest you will pay. 10 lakhs into 12% now 1 lakh 20. In option 2, you should pay interest on debentures as well as on loan. How much? 1 lakh 20 plus 1 lakh 80, total 3 lakhs. In third option, you will pay only on debentures 2 lakh 40. You subtract. You got profit before tax. How much? 6 lakh 30, 4 lakh 50, 5 lakh 10. From their tax rate they given in the question 31.2. Subtract it. You got PAT 4 lakh 33,440, 3 lakh 9,600, 3 lakh 50,800. Sir, all this belongs to what? Equity shareholders only, na? All this amount belongs to equity only because tax interest you paid. Okay. So how much is the equity share capital, sir? 40 in first option. So for 40 lakhs, if they got 4 lakh 33,440, now what is the return to equity shareholders? 10.84. Whereas in second option, the profit after tax is 3 lakh 9,600, but the equity is only 30. So what is the percentage of return? 10.32. In third option, they are having 3 lakh 50,880 as the profit after tax, and the equity share capital is only 30, so they are having 11.70. So in which option the equity shareholders are getting more return? Third option. So which is better? Third option is only better. So now we are moving on to question number 8. Amar has 2 residential house properties. One is used for resident and other is let out. He bought these houses taking loan. During the financial year, he paid interest of 2 lakh 50 each for both the houses and total principal repayment 2 lakhs. He is doing business by name of Mercury Traders, 18 lakhs. So they are asking us to calculate under 115 BAC and under normal provisions also. Okay, first under old regime. So old regime, if you take old regime, first house property income, what is the rent they received, sir? Monthly 50, 6 lakhs. From their standard deduction 1 lakh 80, interest on loan. He bought these houses by, sir, one is used for resident, that is let out. Sorry, self-occupied, one is let out. On let out, he has 6 lakhs, standard deduction 1 lakh 80 and interest on 2 lakh 50. So on this, the income from house property is like 1 lakh 70. Sir, even in new regime also this remains same, 1 lakh 70. Then on let out house property, sir, NAV is nil. Standard deduction is nil, but interest can be claimed as deduction. How much interest he paid? 2 lakh 50. Okay, but on self-occupied property, the maximum interest deduction available is only up to 2 lakhs. Only up to 2 lakhs. On self-occupied property, old regime, the maximum interest allowed as deduction is only 2 lakhs. And that 2 lakhs is eligible to, okay, 2 lakhs loss because self-occupied property, no income. And the loss from self-occupied property can be adjusted with a let out property. Even after that, if any loss is there, that can be set off with other heads also to a maximum of 2 lakhs. Sir, after intra-head set off, still there is 30,000 loss. That could be adjusted with what? Business income. How much is the business income here? 11 lakh 80,000. With that 30,000 house property loss adjust. How much will be having? 11 lakh 50. Then old regime, sir. He has principal repayment of 2 lakhs. Sir, principal repayment is eligible for ETC deduction up to an extent of 1 lakh 50. So that also claim. So what is the total income? 10 lakhs. On 10 lakhs, the tax is 1,12,500 plus 4,500 cess. Total it came to 1,17,000. New regime, what happens, sir? Self-occupied property, they can't claim interest as deduction. That means such loss will not be there. So only you will take what? House property income. House property income will be what? 1,70,000. Then PGBP 11,80,000, total 13,50,000. And then you can't even claim ATC deduction also. So the tax on 13,50,000 is like 1,10,000 and 4,400, 1,14,400. Which option is better, sir? Still option 2 is only better. I mean new regime is only better. Then we are solving question number 7. Mr. A owned 2 residential houses for his residential purpose, details of which are as follows. GAV 4 lakhs, 5 lakhs, municipal tax 2,000, 10,000, interest on loan taken for construction of house 20,000, 25,000. Okay, so total how many houses are there? 2 houses. Okay, then he gifted 25 lakhs to his wife, and then out of such money she acquired a house property for her own residential house property. Okay, sir, when he gifted money to his wife, and wife with that she purchased house property, clubbing provisions, where any money is transferred to spouse for inadequate consideration, with that spouse invests in anywhere, and from that if she earns any income, that also has to be clubbed in the hands of SSC only. Okay, now the question comes is like, sir, he already has 2 houses, wife purchased 3rd house. Okay, wife purchased 3rd house. Okay, but still that also has to be included here only. The new house was a gross municipal value of 2,50,000. She paid corporation tax of 2,000. Compute income first. Sir, how do we solve? First itself we will not take the total house property into SSC and calculate. We will calculate house property income separately for wife. Then final income from house property will bring and include it in the hands of husband. See, sir, all these are like residential properties only. 3. Okay, the point I want to say is like what? He already has 2 residential house properties, wife, another residential house property. If you remember house property properly, sir, when a person is having more than 2 house properties as self-occupied, then the other than extra 2, I mean the 3rd and 4th properties which are kept for self-occupied has to be treated as deemed to be let out. But here understand, we are not calculating house property income under the head of husband only. The property with wife we need to calculate separately, with husband we need to calculate separately. Ultimately the income from house property of wife has to be clubbed in the hands of husband. Why? Because the money is sourced by husband. So take self-occupied house properties, you should take NAV as nil. From there deductions also nothing. Interest, sir, we are following what? Old regime only. Okay, old regime. Okay, interest 20 and 25 both are eligible for set off 45, so the loss 45 income from. Then from wife also it is what? Residential house only. And then NAV is nil. Okay, NAV is nil. Then there is no interest nil. So straight away you will add this. Sir, this question is about what? Here what is the tax planning happened? Sir, with the 25 lakhs, if Mr. A only purchased property, then that property belongs to A. So he is having 3 properties self-occupied. One has to be considered as deemed to be let out and need to calculate tax on it. Okay, that income will come deemed to be let out. This GAV will be taken as the deemed let out income, and then we need to calculate. But here he gifted it to wife, which is a tax planning, so that wife purchased an asset. If any income from that there has to be clubbed on the husband income, but there is no income now, let out property need not to be, even if club also nothing happens. So that is the tax planning here. Then question number 6. Question number 6. Pre-limited own two sons, two undertakings. Undertaking A is eligible for deduction under section 80A and undertaking B are not eligible for such deduction. The date of commencement of operation in both the undertakings is 14 September 2024. The profits earned by both the undertakings are as under. Sir, first 80IA. So what is 80IA deduction? See, 80 deduction. Let me show you the 80IA deduction, sir. See, look at this one, the last one, 80IA. Deduction in respect of PGBP from undertakings or enterprises engaged in infrastructure development like roads, ports, bridges, etc. The deduction available is like what? 100% of their profit and gains for 10 consecutive assessment years out of 20 years. Okay, when they are into the infrastructure facilities like roads, bridges, railways, highways and all. If they are into other projects, 10 years exemption is available, 100% of their profits, but out of 15. Okay, when they are into, they can choose which year they have to claim it as deduction. Okay, now come back to the question. Sir, they are having two undertakings. Okay, undertaking A alone is related to 80A. Sir, this is there in the recent MTP also, mock test paper 2025 also, December 2025 also, this question is there. 80IA deduction is available for undertaking A and undertaking B. Sir, what we have discussed, 100% of their profits are eligible for deduction, right? But not such way. See, 80IA deduction has to be availed or calculated as if such business is the only business to assessee. Chapter 6A deduction in any year cannot exceed gross total income. I mean, 80IA is also part of chapter 6A, so it cannot exceed gross total income. These 2 points. Now we will solve the question, sir. See. Sir, this is not easily understanding, so put your brain. Sir, look at here. Here loss. Profit now will claim deduction. Loss now will not claim. So for this year, sir, when we are calculating gross total income, when you are having 2 or 3 undertakings, all that has to be added or not. So the gross total income is what? Negative 10 lakhs. Then second year, they are again having 4 lakhs loss. But here 10 lakhs profit now. So first they will adjust with this 4 lakhs. How much? 6 lakhs profit is the gross total income. And then the brought forward loss 10 lakhs is there. That if they adjust, here the gross total income became what? 0, and still they are having 4 lakhs of brought forward loss. Third year they are having 5 plus 9. What is the gross total income? Sir, first we are calculating gross total income, sir. Okay, so I am not taking year numbers. 1, 2, 3, 4, 5. Just to save time, I wrote like that. Unit A, B. Sir, A, first year how much is there? Minus 6.
Minus 4.
Minus 6, minus 4. What is the gross total income? Minus 10.
Minus 10.
Is there any carry forward of loss? Yes, minus 10. Then second year also minus 4, 10. Gross total income is 6. But after setting off this minus 10, still there is minus 4. Okay. The gross total income is. So, okay. I will be taking even net total income also, sir, for your reference. After setting off. Okay. What is the gross total income, sir, here? Sir, gross total income is like nil. Why it is taken as nil? Sorry, sir. Okay, minus 10. Carry forward. This is not net total income after set off. GTA after set off. I am adding one more column for us to have clarity. Gross total income after set off. Sir, first year only. Nothing to set up. So it is like what? 0. Okay, because loss we are not taking, we are taking it as like 0. Total income negative na, will not calculate negative tax rate. That's why we are taking it as 0. Okay, then actually gross total income also has to be taken. So we are taking like combined. Instead of calling it as like combined, we'll call. Then minus 4 plus minus 10, set of 6. But brought forward also, if you set off 10, then it will become 0, and carry forward is like again 4. Correct only now what I am doing? Yes. Then third year, how much, sir? 5 and 9, total combined is like how much? 14. But if you adjust the carry forward 4, okay, carry forward will become 0, then the net will become 40. Then fourth option, sir. Okay, sorry, 10 only. After adjusting, it would be only 10, because 14 minus 4, if you adjust, 10. Fourth year, how much is there? 8, 6, 14. Is there any carry forward? No, 0. So how much is the GTA? 14. Then fifth year, 9 minus 3. Combined how much? 6. Is there anything to set off? No. So after that it is like 6. Now we need to find out how much is the deduction available. So first understand, when the gross total income is already 0, can we claim 80IA deduction? Because the chapter 6A deductions cannot be more than total income, gross total income. So year 1, year 2, 80IA is not available. Why? Because the total income is 0 only. Okay, year 3 available? Yes. How much we need to check? Sir, while calculating 80IA deduction, we should calculate the deduction as if only such undertaking is the business. Now, sir, if only undertaking A is only there, if only undertaking A is there, first year loss, second year loss, so total carry forward become how much? Negative 10. And in year 3, if you adjust that negative 10, is there any profit? No. Sir, 80IA deduction we are calculating again, assuming as if that is the only business. So if that is the only business, year 3 they are having brought forward loss of 10, and the business profit is 5. Still they are having a carry forward of 5 lakhs loss only. So year 3 also 80IA available or not available? Not available. Year 4. Year 4 how much profit they are having? 8. And the brought forward is how much? 5. If you set up, how much is there? 3. Okay. So year 4 they will get 80IA deduction, how much? 3 lakhs. Which is less than even the gross total income also. Okay. Then year 5. Year 5, how much is there, sir? 9. Okay. Is there anything to be carried forward? No. Okay. So now how much is the 80IA deduction available? 9, you think? No. But for year 5, the gross total income is only 6. So, okay, gross total income is only 6. So deduction can't exceed gross total income. So that's why 80IA here in this year, even though profit from such undertaking is 9, it is restricted to how much? 6 lakhs only. Restricted to 6 lakhs only. I hope you are understanding, sir, the point. See now. First 2 years, why they ignored? Because already lost, so ignored. Profit from unit A 5, 8, 9. Unit A only we are checking, sir. Then profit from unit B 9, 6 minus 3, 14, 14, 6. Sir, deduction under 80IA. Sir, current year profit from unit A is 5. But assuming if only unit A is there, now first 2 years they are having 10 lakhs loss. Okay. So if they adjust, balance is 5. Okay. So from if they check like only unit A is available now, in 27, 28 also no deduction available. That's why we have striken off year for year 3 also. But year 4, sir, current year profit 8 and brought forward loss is only 5. Sir, why they are writing like notional? Because this is we are assuming only for the purpose of 80IA. Then balance 3. So for year 4, how much is available, sir? 3 lakhs is available. If you subtract that 3 lakhs from, sir, here year 4 how much? 14 na? 14. Gross total income. Here we said like deduction 3 lakhs available na? If you subtract, the net total income is how much? 11 lakhs. Then the last final year also. Okay, they got business income 9. There is no brought forward notional loss. So 9 lakhs. But they can claim 9 lakhs as 80IA deduction. But 80IA deduction cannot exceed gross total income. So it is restricted to 6. Okay, so the total income is nil. Then we'll solve question number 5 also. Lucent purchased machinery on 1st April for 10 crores by availing loan facility from the bank. The machine was put to use in effective production on 1st February 2025. The interest on loan works out to 12% per annum. Advise Lucent Limited on the treatment of interest payment made on this loan and depreciation allowable for the previous year 24-25. You may assume that this is the only machine in its block. Only machine in its block. Sir, what happens? Machine when purchased? 1st April. When it is put to use?
First February 2025.
So if you remember PGBP, sir, okay, the interest on loan up to the date of put to use has to be capitalized and need to be added to the asset. So 10 crores into 12% up to 1st February na how many months? 10 months.
10 months.
So 10 crores into 12% na 1.2 crores into 10 by 12. If you do 1 crore, you need to what? Asset cost. Okay, you need to add to asset cost. So if you see the plant and machinery purchase value is 10 crores, and if you add that interest 1 crore, total purchase value of asset is how much? 11 crores. And then the asset is used for a period less than 180 days. Why? Because it to put to use only on 1st February. Since it is put to use for less than 180 days, depreciation is restricted to 50% of the actual. So 11 into 15% into 1 by 2, which is 0.825%. Okay, whereas for the February and March month related interest, that can be claimed as deduction under the PGBP. Okay, then the first 4 or 5 questions are, it's based on tax planning theory. Okay, let me show you that one also. Theory very easy, sir. We need not to read it line by line also. I'll explain you. Maximum 5 minutes, 5 to 10 minutes, including the question solving. See, tax planning. Sir, we are having 3 segments here: tax planning, tax avoidance, tax evasion, tax management. Sir, tax planning na throughout this chapter we solved questions, right? Thinking of multiple options, okay, and finding out which is the better alternative. Sometimes we are claiming deduction, sometimes we are thinking like old regime, new regime, like whether to buy an asset, lease an asset, whether to avail capital gain exemption or not, whether to avail salary allowance or to take it as a perquisite. All this which we did in this chapter is tax planning, which is legal, ethically correct, morally correct, and it is encouraged by the department also. This is called tax planning. Then tax avoidance. Sir, tax avoidance na, like it is legal only, it's not illegal. Tax avoidance is legal only, it's not illegal, but ethically it's not correct. Okay, you are exploiting the loopholes in the tax. You are exploiting the loopholes in tax, and then you are getting a undue advantage. Okay, but the problem with it is like it is short term only. Not today, tomorrow, or after 1 year, 2 years, the government is gonna notice that here there's a loophole. That's why people are exploiting this issue. So obviously they'll frame the law in a better way. They'll make amendments and all. Then you will not be having a chance to tax avoidance. So legally, there's nothing to say that you are wrong, but ethically it's wrong. Tax avoidance. Okay, you are exploiting some kind of loophole in the taxation policy. Okay, so I said, sir, in MAT provisions also, Reliance has did for so many times, like to avoid MAT provisions and all. Initially they have met in so many ways to avoid the tax and all. Okay, then tax evasion. Tax evasion, this is illegal and even morally also immoral it is, or ethically also wrong. What you are doing? Tax evasion means, sir, you didn't even take an LIC, but you bring a fake LIC receipt and claiming ADC deduction. You didn't even had children, but you are claiming exemption for children's school fee allowance. So those things, okay, even though it's not a genuine thing, you are claiming false expenses and all, then that is called tax evasion. Okay, tax planning is like effectively planning tax which is legal, which is ethically correct, which is encouraged by department also. Tax avoidance na morally wrong, ethically wrong, not encouraged by department. Sorry, legally correct, ethically wrong, okay, not encouraged by department. It's only short term benefit. Today or tomorrow the government is going to find out and they're going to cover the provision properly. Tax evasion, fundamentally it's wrong. What ab initio? Why? You are doing completely fraud only, malified intention only, because what you are doing is illegal and even ethically also wrong. Tax management, sir, tax management na, you are not thinking of to reduce tax anything, sir. In tax planning, avoidance, evasion, in all these three things you are thinking of reducing your tax. Planning is a correct way, avoidance is legally correct but not ethically correct, evasion ethically and even legally also not correct. Management, you are not trying to reduce anything, but you are trying to manage things properly. Like you want to you will be filing the returns on due date. When any TDS provisions are applicable now, you will deduct TDS on time, pay the TDS on time. If any PAN numbers has to be collected now, you will collect them on time. So procedurally you will do in a systematic way properly. Why? If you do that, you can avoid penalties, okay, you can avoid other interest. If any assessment comes also, you can provide records and all properly. That's called management. So you are complying properly, and that is called as tax management. Tax planning, avoidance, evasion, management. So the theory, whatever you do, that will only be there, okay, even if you read also, whatever I have explained now, that will only be there, repeating so many times. So if you go to the questions, question number 1, you will just look at these points and tell what is tax planning, what is tax management. Filing ITR before the due date in order to carry forward business. Management. There is nothing like to reduce tax here. Then setting up a warehouse to avail tax benefit under 35 AD. Planning. Payment of medical insurance premium for parent. Planning. Collecting PAN details from contact. Management. Then recording in the books of accounts salary payment to J who is not actually employed by SSC. Illegal, sir, this is. Okay, so it is what? Tax evasion. Paying advance tax installments in accordance with section 2 level. Management. Gifting a property to major son in order to divert rental income so that it is taxed at a lower slab rate. Planning only. You may think like diverting, they said na, you may think like maybe some avoidance or they are doing. Sir, you are transferring property to your major son. Why? So that he will be taxed the rental income. So it's an effective way of tax planning. There is nothing like illegal. Then discuss with brief reason whether the following will fall under the category of tax planning avoidance. Setting up of a licensing office in India by foreign company instead of a full-fledged establishment to run its business activities. Why? Planning only, sir. If they start a full-fledged establishment, it amounts to PE. When they are having a PE na, then the income associated with it will be taxable in India. When they are having just a license office, then it is not a PE. So there is no business connection established. When there is no business connection established, the related income will not be considered as accrued in India. So it is what? Tax planning. Then claiming depreciation for business purposes for a solar power generation system installed in the residential premises of proprietor. Sir, personal expense, claiming it as business. Tax evasion. Investment in bonds approved by 54 EC. Planning. Third one. Sir, they are paying health insurance premium for himself and his family. Sir, paying health insurance is what? Tax planning. Then B submits form 15J through his income exceeds the basic exemption limit to avoid TDS. Sir, 15G through his income exceeds the basic exemption limit. Sir, when form 15G will be submitted, when your income is less than basic exemption limit and for you TDS not required to be deducted, then you will submit form 15G. But here it is more than that. So you are doing illegal tax evasion. Maintains proper records of TDS deducted from employers. Tax management. 1,50,000 invested in PPF to reduce tax liability. Planning. Create fictitious entries na, false entries, created entries. Tax evasion. Mr. A forgets to file his return by the due date but files it before the end of assessment year. Management only, sir. Sells agricultural land located in rural India and claims it as exempt income, tax planning. Business depreciation as on personal car, evasion. Mr. I calculates advance tax and liabilities and pays installments before due dates, which is like tax management. Earns 4,000 as interest from savings account and claim 80 TTA, planning. The last questions are now. We have covered each and every question within 2 hours from the tax planning chapter. Satisfy whether the following acts to be considered as tax management, planning or evasion. Premium paid for life insurance, tax planning. Installed air conditioner in residence but claiming depreciation as factory, tax evasion. Registers of tax deductions affected by it to enable the timely compliance, which comes as what, sir? Tax management. Then Z Limited issues a credit note for 36,000 for brokerage payable to A, who is the son of G, managing director of the company. The purpose is reduce Z Limited income and increase A's income from 18,000, sir. Z issued a credit note for 36,000 for brokerage payable to A, who is the son of G, managing director, company. Sir, which has to be given to A was given to G. Why? If it is 36,000, okay, which is like what? Falsely wrong. Okay, tax evasion. Then A is a working partner. In such capacity, he is entitled to salary of 7,500. He treats its salary as salary instead of business income. Wrong, sir. Any profit or any remuneration interest coming from a partnership firm has to be treated as business income only. So this is what tax evasion only. Using a motor car for personal purpose but charging depreciation as business expenditure. Evasion. Advance tax on time, pays advance tax on time, management. Sold his residential house and purchased another house to claim exemption under 54, planning. X has fixed deposit amount to 15,000 but did not disclose this amount in his tax return, tax evasion. Okay, and the last one, X has saving deposit interest amount 5,000 and they claimed 80 TTA deduction, tax planning. So each and every question is solved, sir, from this chapter, and each and every question is solved, and the materials are also available in Telegram group. You solve each and every question, because if you have observed, we have 24 questions. Except the first 2 or 3 questions, rest all are of different models only. That's why we solve each and every question. If you watch this lecture, obviously your confidence will boost from tax planning chapter.